Get ready to unlock the secrets of tax credits and deductions in our latest episode of the Ask Ralph podcast. Did you know that understanding tax credits can save you money and potentially lower your tax bill? Well, we're going to break it down the difference today between a tax credit and a deduction for you and explore some of the most common tax credits that are available when you're preparing your 2023 tax return here in 2024. From the child tax credit to the earned income tax credit, we're going to cover it all. Plus, we'll delve into some lesser-known credits, like the Lifetime Learning Credit and the Residential Energy Property Credit. So stay tuned and join us on this financial journey.
Welcome to the Ask Ralph podcast, where listening to an experienced financial professional can help you make sense of confusing questions, current headlines, and industry trends about taxes, small business, financial decision-making, investment strategies, and even the art of proper budgeting, as Ralph makes the complex simple by sharing his real-world knowledge with all things financial. Now here's your host, Ralph Estep Jr.
Welcome back to another episode of the Ask Ralph podcast, where we dive deep into the world of finance, taxes, business growth, and personal success. I'm your host, Ralph Estep Jr., and today we have an exciting topic to discuss: the difference between a tax credit and a deduction. We're also going to explore some of the most common tax credits that you can use in 2024 when you file your 2023 return, and touch on some lesser-known credits as well. But before we get started, let me ask you a question. Did you know that understanding tax credits can save you money and potentially lower your tax bill? Well, we're going to dive right into that today and uncover some of these secrets. So let's answer the question: what exactly is the difference between a tax credit and a deduction? Let's break it down. Tax credits and deductions are both valuable tools that can help reduce your tax liability, but they work in different ways. A tax deduction lowers your taxable income by subtracting eligible expenses or deductions from your total income. This reduces the amount of income that is subject to taxation. So, for example, we would start with your adjusted gross income. We add in your W-2 wages. We add in your interest income, maybe pension income or other incomes. And then these deductions are used next to reduce your taxable income, and then your income tax is based on that taxable income. Now, on the other hand, a tax credit directly reduces the amount of tax you owe. It's applied after your taxable income has been determined. So, for example, we start with your adjusted gross income, then we have a place to deduct your deductions. Sound like I've been a little redundant there. For example, mortgage interest, property taxes, all those things, Schedule A items. That arrives us at taxable income. That taxable income is then subjected to the tax that applies to that amount of income. But then the tax credit actually reduces the tax dollar for dollar. So let's talk about some of the most common tax credits for 2024. Again, these are going to be used for filing your 2023 tax return. These credits can provide significant savings if you meet the eligible criteria. The first credit we'll discuss is the child tax credit. This applies to probably 90% of my clients that have children. This credit allows eligible taxpayers to claim a credit for each qualifying child under the age of 17. That's the key. They have to be under the age of 17. The credit amount may vary based on income level and other factors, but it can be a substantial benefit for families. So let's break down some of the details. Eligibility. To qualify for the child tax credit, as we talked about, the child must meet certain criteria. They must be under the age of 17 at the end of the tax year, be a U.S. citizen, national, or resident alien, and meet the relationship test. For example, that would be your child, a stepchild, foster child, sibling, or descendant of any of them, and live with you for more than half the year. So once they're eligible, the credit amount can be up to $2,000 per child. Now, you have to understand that as I'm recording this, these numbers could change as tax laws change. This is a tax credit, meaning it directly reduces the amount of federal income tax owed by the taxpayer. So, as we talked about a few minutes ago, if we come up that your total tax burden is $4,000, for example, and you have one qualifying child, and the child tax credit is $2,000, then your new magic tax bill has been reduced to $2,000. So that's how that credit works. Now, there are phase outs depending upon your income. So you want to consult with the IRS website or, work with somebody like myself to handle that. And there is what's called the additional child tax credit. So if the child tax credit exceeds the amount of tax owed, taxpayers may be eligible for the additional child tax credit. This credit is refundable, meaning it can result in a refund even if the taxpayer doesn't owe any tax. So you come up with your total tax burden is $4,000, but let's flip the script and say you have 3 children. So you would have a child tax credit of $6,000. So basically you would wipe out completely all the tax that you owe. Well, the additional child tax credit would actually let you take that $2,000 and get that as a refund coming back to you. So I think we've kind of covered the child tax credit. Let's move on to the earned income tax credit, or you may hear it called the EITC. This credit is designed to help low to moderate income individuals and families. The amount of the credit depends on factors such as income, filing status, and the number of qualifying children. It's important to note that the EITC is a refundable credit, meaning that if the credit exceeds the tax liability, the taxpayer may receive a refund. So what we mean by refundable credit versus non-refundable credit. If it's a refundable credit, that means you can actually drive your tax burden below zero, where they'd actually give you money back. A non-refundable credit would just knock out your tax burden, but they wouldn't send you any money back. So here's some key points to know about the earned income tax credit. As far as eligibility, you must meet certain requirements, such as having earned income from working for yourself or as an employee, meeting income limits set by the IRS, and filing a tax return even if you're not otherwise required to do so. In other words, the IRS can't send you this out of, conjure it up out of midair. You're going to have to file a tax return to make this happen. Now, there are some income limits. The income limits for eligibility vary based on filing status and the number of qualifying children you have. Higher earnings can reduce or eliminate the credit, and there's an upper limit beyond which the credit is no longer available. So there is a sweet spot in this, depending upon what your income is. Now, as far as qualifying children, having one or more qualifying children significantly increases the amount of the EITC you can receive. A qualifying child must meet criteria related to age, relationship, residency, and dependency. Now, the EITC is calculated based on a percentage of your earned income and the number of qualifying children you have, and I'm not going to get into a discussion about those numbers. The credit gradually increases as earnings rise until it reaches a maximum amount, after which it's gradually phased out. As we talked about, this is a refundable credit, meaning if the credit amount exceeds the tax owed, you may be eligible for a refund. This can provide a significant financial boost to eligible individuals and families. Now, certain individuals without children can also qualify for the EITC, although the credit amount is generally lower. In addition, there are specific rules for individuals with a qualifying child who is the child of more than one person. So this gets complicated. That's why I preach about this in my podcast, that you really need to work with a tax professional. Let's move on to some of the lesser known credits that you may not be familiar with. One such credit is the Lifetime Learning Credit. This credit allows taxpayers to claim a credit for qualified education expenses paid for themselves, their spouse, or their dependents. It can be used for undergraduate, graduate, or professional degree courses, as well as courses to acquire improved job skills. The amount of the credit is based on the qualified expenses and the taxpayer's income. So let's dive into some details about the Lifelong Learning Credit. As far as eligibility, to qualify for the Lifetime Learning Credit, you must meet certain criteria. You must be enrolled in an eligible educational institution, such as a college, a university, or vocational school. The credit is available for both undergraduate and graduate courses, and there is no requirement to be pursuing a degree or certificate. Let's talk about what the qualifying expenses are. The Lifetime Learning Credit can be claimed for tuition and fees paid for eligible courses. This includes expenses like books, supplies, and equipment required for the course. However, room and board costs, transportation, and personal expenses do not qualify for the credit. So you're going to need to break down those expenses. There are income limits, meaning the eligibility and the amount of the credit may vary based on your modified adjusted gross income. And we get into a technical term. There's a calculation that's required here. The credit generally phases out as income increases, which aggravates a lot of my clients who are, middle to higher income earners. And once your modified adjusted gross income exceeds the maximum amount, you're no longer eligible for the credit. And I'm going to, the credit could vary depending upon how much income you have, but generally the lifetime learning credit allows you to claim up to 20% of the first $10,000 of qualified expenses with a maximum credit of $2,000 per tax return. It's important to note that the credit is not refundable. So as we talked about a few minutes ago, this will not allow you to get this money back, but it will negate any tax that you might owe. It can reduce the amount of tax you owe, but cannot result in a refund if it exceeds your tax liability. Unlike some other education credits, a lifetime learning credit does not have a limit on the number of years you can claim it. You can claim the credit for any number of years that you are eligible and have qualifying expenses. So if you want to be a student for life, you could actually continue to take this lifetime learning credit. However, it's worth noting that you can't claim both the lifetime learning credit and the American Opportunity Credit for the same student in a single tax year. Now, let's move on to another lesser known credit, and that's the Residential Energy Efficient Property Credit. This credit applies to the installation of solar electric systems, solar water heating systems, geothermal heat pumps, and small wind turbines. If you made energy efficient improvements to your home, you may be eligible for this credit, which can help offset the cost of these upgrades. It's important to note that these are just a few examples of the many tax credits available. There are various credits for different purposes, such as education, energy efficiency, adoption, and more. It's always a good idea to consult with a tax professional or refer to the IRS website for more information on eligibility and how to claim these credits. Well, before we wrap up today's episode, I want to remind you to visit our podcast page, AskRalphPodcast.com. We'd love to hear your feedback and suggestions for future episodes. Leave us a review or send a message. You can click on the little microphone icon and actually leave us a voicemail message and let us know how we're doing and what topics you'd like for us to explore in upcoming episodes. Thank you for listening to the Ask Ralph podcast. We hope you found today's episode informative and helpful in your financial journey. Understanding these credits can help you maximize your tax savings and keep more of your hard-earned money. Remember to consult with a qualified tax professional or refer to the IRS website for detailed information on eligibility and how to claim these credits. Remember this, understanding tax credits can make a significant difference in your overall tax liability and financial well-being. So as I always say, stay financially savvy, and until next time, God bless you.
Thank you for joining us on the Ask Ralph podcast. And with a simple click to subscribe, we'll invite you back to our next episode. And remember, financial issues don't have to be complicated. Just ask Ralph. The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media, Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.